We just published our monthly Strategizer publication, which is our go to report for active investment managers and asset allocators. And the conclusions were too important to not go through a bit of advertising. So here goes. For one, our equity scorecards deteriorated this past month for practically every region of the world, most notably this year's red hot but now super expensive European market. And we also saw deterioration in the US and in Canada, where valuation sentiment and investor positioning have all moved to what we see as highly uncomfortable levels and getting more unhinged in terms of dismissing or downplaying the recession that's actually staring us in the face. The only market that saw improvement in the Strategizer scorecard, which means the market that now has the most compelling risk adjusted return potential for the next 12 months, is Japan, which, by the way, we are also on the precipice of publishing a special piece on Japan in Breakfast with Dave. This is a market underpinned by a still easy monetary policy stance, a cheap currency, and stimulative fiscal policy. Attractive valuations, positive earnings momentum, and a drive by Japan's corporate sector to improve cash returns to shareholders. In fact, it isn't all that well known that total dividend payout ratios in Japan have just caught up with where they are in the United States. Our currency model, by the way, it also shows that the Japanese yen, out of all the major currencies, has the greatest upside potential of all the majors in the coming 12 months. So the message here is that you want to buy the Japanese market and you want to buy it unhedged. For those investors that need to be fully invested in the S&P 500, our top sector recommendations show all the defensive areas screening best, which makes sense in a flat to negative economic backdrop. That includes telecom services, consumer staples, and utilities. The only cyclical area, though we see this now more as secular growth, is energy, which remains very alluring as well as it has for the past year and change. Our duration model showed some modest erosion, but we still prefer bonds to stocks within the asset mix, and within bonds, high quality investment grade corporate credit continues to screen very well in our models. Let me finish off by saying that we've stripped gold out of our commodity model. And while the overextended technical picture points to a near term pullback, this is a pullback in bullion that is to be bought given the longer term secular positive tailwinds premised on dollar weakness and lower interest rates ahead now that the Fed is done or close to being done with this tightening cycle. For more on the Strategizer publication and how to access it, or any other report that we produce here at Rosenberg Research, please visit us at information@rosenbergresearch.com. And please take advantage of our offer for a 1-month free trial of everything we do, both written and oral.